This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Hey, Jason, just wanted to send you a quick message of gratitude. I'm so grateful that I got into the game and got in with properties that make sense because the rent income keeps coming in. So thank you. Glad we connected, and I'm glad to be in the income property game instead of the Wall Street game for my future.
Welcome to the Creating Wealth Show with Jason Hartman. You're about to learn a new slant on investing, some exciting techniques, and fresh new approaches to the world's most historically proven asset class that will enable you to create more wealth and freedom than you ever thought possible. Jason is a genuine self-made multimillionaire who's actually been there and done it. He's a successful investor, lender, developer, and entrepreneur who's owned properties in 11 states, had hundreds of tenants, and been involved in thousands of real estate transactions. This program will help you follow in Jason's footsteps on the road to your financial independence day. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Welcome to episode 2224, and greetings from Las Vegas, Nevada, where we hosted our collective mastermind event this weekend, and we went to see the Eagles. We took everybody to the Eagles concert at the incredible $2.3 billion Sphere this week. Those tickets were $1,000 a piece, so we took 40 people, but it was a great time. And my partner in the collective mastermind is none other than Robert Helms.
Hey, everybody.
Real Estate Guys radio show. And I thought I'd do the intro with him here today. Let's walk over this way so we're kind of in the shade a little bit.
Let's do it.
But Robert, what's on your mind as far as the real estate market?
Well, it's life in the fast lane, everything all the time.
That's an Eagles lyric for those of you who don't know, but yeah.
And, we're just paying attention to movement of people, markets, all that kind of stuff. Real estate is based upon the value that people put on it. They want to have businesses places. They want to build spheres places. They want to have housing places. And so every day people are leaving markets. Every day people are going to markets. So we try to go to where people are going.
What opportunities are on your mind nowadays? You interview a lot of guests and, have your pulse on the market. You're hosting your mastermind here, and I just was honored to speak there. So I just gave a presentation there. But, what's on your mind, either maybe from my talk or in general?
Yeah, well, one of the things I always appreciate that you do is talk about pricing things in other assets. We looked at real estate priced in gold, real estate priced in oil. And when you take that view, you recognize that in some ways, real estate isn't at its peak today. Real estate's actually below the peak.
Yeah, it's really interesting. The reason I created the Hartman Comparison Index, the HCI, is because people are making faulty decisions by comparing the value of real estate to only one thing, the U.S. dollar.
Right.
And the U.S. dollar is a moving target. Everything's a moving target, right? Gold, oil, all the other commodities in the index. But at least when you compare to multiple moving targets, you get the average of them, and you make better decisions that way.
Well, the dollar is a medium of exchange. It doesn't have intrinsic value, but things like wheat and oil and gas and gold do. And so people make those decisions with their dollars to invest in something that is gone forever, like the $1,000 we spent to see the Eagles. It was worth it investing in memories.
Buying a memory, yeah. I did a talk on that on Saturday.
Yeah. But at the same time, we're also looking to put our money places where it'll be safe, secure, and perhaps make a return.
Yeah, absolutely. So our guest today, Robert, you don't know this guest, but he is an institutional real estate investor. He's CEO of a company that has 5,000 single-family homes.
You know what I call that, Jason?
What's that?
A good start.
Good start, yeah. That's, boy, if anybody listening got to 5,000, speak up. I'd love to have you on the show as well. But he's got some really phenomenal data. By the way, this is one of those that, go ahead and listen to it on the podcast, but try and jump over to YouTube to see the charts and graphs, because there's a lot of them. This is a data-heavy presentation. But we definitely explain those, so you don't need to see them visually, but it's always a nice refresher if you do. What's your take on institutional investors right now? What are they up to? You've done a lot of shows on this.
Yeah, absolutely. They think differently. Mom and pop investors, we look at things that might be a little different than what the institutions do. And part of that's because institutions have to move a lot of money at once, and they have different criteria. Sometimes they can actually move quick. People say, well, they're slow to move. No, they might be slow to originally get into position, but once they made their decision, they go, and they have access to a ton of capital. So we can learn a lot as mom and pops from what the institutions do.
Yeah, we can. So, institutional investors, one of the things I've said over the years is that I think they're a net benefit to us as mom and pop investors because they're much better at managing their yield, raising rents. Mom and pop owners get pretty lazy about rent increases. I mean, you see all these people that have owned the houses for years and I like the tenant, I don't want them to move, and they just never raise the rent, and the rents are like 10 years old. You've got to manage your yield as an investor. That's what you're supposed to be doing.
We have a couple of our Collective Inner Circle members right now who are looking at a property here, and this is exactly the situation. About $220 per month per apartment below what the market is.
Yeah.
And they came to me, so can this be right? Why would people leave this much money on the table? I call it lazy landlord syndrome. If you're a lazy landlord, you just, set it and forget it. For what they paid for the property and their mortgage, those rents are just fine. But an institution would never do that.
Yeah.
They're not emotional about it. They're going to say, what could we reasonably expect to get? By the way, they're also not emotional the other way. If rents soften, then they'll make the decision to bring their rents down so they can attract those clients.
Yeah, absolutely. And one of the things that I talked about in that presentation I just did, and you were there hearing me, is how investors get too caught up in the micro and they just miss the big macro trend. They'll watch a video from some clickbait YouTube guy saying, real estate market's softening or doing this and that, and it's not softening, right? There's a couple of markets that got over their skis and they adjusted a little bit, like Austin, Texas is a good example. But overall, the macro trend is housing shortage, and don't pay too much attention. Like, you got to pay attention, but sometimes paying too much attention to the micro leads to some faulty decisions.
That was a great point you made. We want to pay attention. We want to know where markets are going, but it's like checking your stock portfolio every 60 minutes.
Right.
I mean, if you're a fundamental trader, you're not going to...
Day trader.
If you're a day trader, though, a tactical trader, you might do that. But for most of us, we're not checking the price of every rental home every day or every week or every month. But you do want to keep your head in the game. So you don't want to set it and forget it. But to your point, you don't want to spend all day long in the weeds on the data.
Absolutely. There's a good balance there. And, we're just remember, like the old, I think it's an Aesop's fable about tortoise and the hare, right? Slow and steady wins the race, folks. And that's what real estate investing is all about. So we'll wrap it up for now on the intro portion, but we've got a great guest right here. And we're going to hear from an institutional real estate investor perspective. A lot of data here. I think you're really going to love this episode. So let's go ahead and get to it.
Buckle your seatbelt. Here we go.
So you all know build to rent is a huge trend. We've reported on that for many, many years. Institutional players are making a bigger and bigger mark on the real estate market. However, the question is always, compared to what? Compared to the overall housing stock, they're still a very small player, but they are getting bigger and bigger. And it's really important to talk about this trend. So we have a great guest to do that today. Richard Ross, CEO of Quinn Residences. They started only about 5 years ago. They have just over 5,000 homes, purpose-built, build to rent. We're going to talk about some really interesting rental and price appreciation trends and why this asset class is the right place to be. Richard, welcome. How are you?
I'm well. Thank you, Jason. Glad to be here. I appreciate you having me on the show.
My pleasure. You're coming to us from Atlanta, and you are looking to raise a whole bunch more money and get another 5,000 units under your belt, I hear.
That's correct. We are already well along in the process.
Fantastic. So just broadly speaking, Richard, what makes you and your competitors in the space so bullish about single-family rental properties?
So there's a couple things, Jason, that are driving the business today and have been for the last, let's say, 10 years, but really the last 5 pre-pandemic. And that is a shortage of supply of affordable, what I would call reasonably priced housing in this country. Depending on who you believe, there's a shortage somewhere between 3 and 6 million homes in this country, meaning we haven't built enough homes since the GFC, right? Since the great financial crisis. So there's a shortage of supply.
Yep.
Then you turn to the demand side, right? And you have aging millennials, right? Millennials are turning 30, mid-30s, late 30s.
Oh, hey, the oldest millennial is 43 now. So
yeah, there you go. Anymore. And they're having children later.
Right.
And typically, right, young people live in an apartment for the early stages of their life, whether that's from 25 to 30. And so that cohort is aging. So they're coming out of apartments. Forget the pandemic. This is all before the pandemic when we started this business. As that cohort ages, they want more space. They may have children, may not. And we'll get to the demographics of our particular residents because it's very surprising. And then you have the pandemic that threw, I like to say, gasoline on that migration out of sort of the apartment, the shared corridor, into a more single-family home type of living situation, because people didn't want to share internal spaces. And then you have also...
In other words, I just want to stop on that for a second. In other words, during the pandemic, as I predicted, roommates would split up and there would be fewer people to a household, which we've definitely seen that trend come true. I was right about that. Yeah.
Correct. Absolutely. That, and you, even if you're alone in an apartment, or it's you and your partner, you don't want to walk down the same corridor where Bill and Susie are walking down, and they've got COVID and they're coughing or whatever. So
and you definitely don't want to be in the same elevator.
Correct. Exactly. And so our product is we build communities purposely for rent, and they're either townhomes or what we call detached homes, detached single family homes or townhomes, where you have your own entrance, 2-car garage, typically a fenced backyard. That's our sweet spot. And the other thing you're seeing in the demographics and the resident profile is that there are a lot of folks who are renters by choice today. Renting has always been about 15% of the population, and I can put some information up on the screen that'll...
Yeah, please do. You've got some great charts and graphs for us.
Let me just share this first one here.
All right, for those listening just on audio only, not seeing the video, this chart is showing a large addressable market in the early stage of its institutionalization. What does that mean? That's a complicated way to say, look, there's a big market here, and institutional investors are jumping in, and we're showing here that there's about 132 million total households. I reported on that for years now. About 45 million are rental households, and 87 million are owned homes. So let's split this up a little more, Richard, and look at apartments.
Sure. So let me walk you through it. And by the way, historically, this ratio of 2/3 owned homes to 1/3 rental has been consistent in this country for the last 40 years. Mm-hmm. So that percentage, it changes 1% or 2% every year, but not much. Yeah. And then if you take that a third of rental homes, which is 45 million rental homes, and you start looking at what makes up those rentals, 47% or just under half are apartments, right? Mm-hmm. 5-unit apartment buildings or more. A third are single-family rental houses, which is the sector that we play in, right? Then you have 2 to 4-unit buildings. Those are like duplexes and smaller, which maybe many of your investors own, your audience owns. And then you have sort of manufactured and other rentals. So with that 14.5 million single-family rental homes, what's interesting in this slide here is there's a very small percentage of their institutionally owned, meaning your target audience owns the other 97%, which are people who own between 1 and let's say 50 rental properties. Most of that is housed in people who own 1 to 5 rental units. When you look at the build to rent share of those single family rentals, so that 14.5 million, only less than 1%, which is 150,000 homes are built to rent. So
so let me recap that for a second.
Yes, please.
So of the rental homes, some are apartments, some are single family, some are plexes, if you will, some are mobile homes and so forth, or manufactured homes. And then how many of the rental homes of any type are institutionally owned? That's just 3%. And look, I like RFK. I was honored to share the stage with him at a recent event where we were both speakers, but he and other politicians have sort of fearmongered this a bit. Oh, institutional investors are buying up America. Soon you'll have to rent your home from BlackRock, and this is just not true, folks.
Yeah, the facts do not bear that out. No,
not even close. Look, 97% of the rental housing stock in the U.S. is owned by regular non-institutional investors, Only 3% is institutional. And of that small amount of 3%, only 1% of that was designed to be rented, in other words, BTR, or build to rent. 99% of that, they're just buying regular single-family homes. Now, I guess there you could fearmonger a bit and say, well, they're competing with regular families wanting to buy regular single-family housing stock and rent them. But, what I really wonder about this chart, Richard, which I'm not sure it's really showing us this, of the 3%, that are owned by, these are all SFRs. They don't include apartments. Got it.
Correct. Apartments today are about 30 to 50% institutionally owned.
Right.
Depends by market. Meaning,
and then mom and pop.
that may be where this business goes over the next 30 years. But this 97 or 99% are typically investors, again, who you don't know how they came about. I believe it starts when, you live in a home, you're in your starter home, you're a 35-year-old millennial couple, and you bought your starter home, and then you want to move up. So you move up, but instead of selling your original home, you rent it, right? Yep. And then you might see, oh, this is a really good little side business, good investment. So maybe I'll buy another home down the street or in the next town over, and, maybe it's in disrepair, and I'll fix it up and, then rent it. So I think that's how you get these 99% that are non-institutional. And someone, over time, over 5 or 10 years accumulates, 5, 6, 7, 10 of these units. That's happening all over the country and has been.
Yep. People have definitely discovered that this is the most historically proven asset class in the world. I've been saying that for, 25 years, but, finally the world has discovered it. Okay. So, elaborate on this a bit. Those are some good numbers you just shared with us. What do you see happening? Where is this going? How much of the housing stock will be owned by institutional owners for single-family housing stock?
So what has happened, I think a good indicator, right, or arbiter of that is to look at multifamily. I started my career in multifamily in the early 90s when there were all the big companies that own apartments today, and the names. It's Avalon Bay, it's Camden, it's Mid-America.
Company.
Yeah, these are all big public companies.
Sure.
They were all created in the early 90s. And back then, their percentages were like we just saw on the chart, less than 5%. Today, they're somewhere between 35 and 50. It depends on, again, who you believe and what the universe is. So, and that's probably where it will stay, right? Because you're going to have mom and pop, as we call them, owners and smaller companies that own. So that is the opportunity in the build to rent sector. But it took 30 years in the apartment industry asset class to get to that concentration of institutional ownership.
Yeah. Okay. So do you see the money continuing to flow to these institutional players so they can buy a lot more stock? And what's the more recent trend? Is it, slower now, or are they on big acquisition binges?
Well, no. Obviously, the interest rate environment has sort of put the brakes on, I would say, the go-go days, if you will, when there was essentially free money, right? Your sub 3% interest rates. So that over the last 2 years has really put the brakes on new investment and new purchasing and building of communities for rent. Having said that, as we talked earlier in the show, the dearth of supply and the demand drivers, which are aging millennials and all the things. Look, I'm going to share another particular slide with you. So this shows you sort of the demand. We talked a little bit about the supply. That's on the right side of this chart, meaning you see the shortage of homes for 2024 is estimated at 3 million, going up to 3.6 million in 28. This is a very conservative number. Some people put it at 5 to 6 million. Yep. What this chart shows you at the bottom right is that we're still not building enough homes in this country. And I'll give you an example. I may get the numbers wrong, but they're close. In 2023, 1,000,007 households were formed in this country. That means roommates moved out, or people left their parents, or they became of age, or you had immigration, right? A huge immigration in this country. So 1.7 million households were formed. We only built 1,000,004 homes, meaning we're getting farther behind. So that 3 million, 5 million, 6 million shortage is getting bigger, not smaller.
Right. We're not even keeping pace.
Exactly.
Right. But Richard, and I rail on them all the time. There are so many of these doomers. They're all over YouTube with their clickbait titles about the housing shortage is not true. They say that there's ample supply, there's going to be a crash and all of this stuff. What do you say to that? I know it's not true because I have firsthand experience every day, for decades in seeing how this is playing out. But, there are some that manage to spin the statistics and, sort of spin doctor the numbers and make you think there's not a housing shortage.
Right. I think what you have to base it on is the hard facts. And that is, we know, the Census Bureau puts out this data. They spend a lot of our taxpayer dollars on accumulating it. And it's very clear how many households are formed and how many homes there are. And it's very clear there's a shortage. And I'll give you just very straightforward answer.
And one more thing I'll add to that. It's very clear that it's going to get a lot worse before it gets better. Go ahead.
Correct. Because people are aging. And when people, as the population ages, so in the slide I'm showing in the upper left, you see the average age of people 35 to 44 who are our residents. That's who typically, our average age is 38 years old. So
they're renting your single family homes.
Right. Yes.
Your average renter.
Our average resident is 39 years old. You see how that's continuing to grow. So those people are coming out of apartments or mom and dad, right, living with parents and moving into our homes, which is the demand side of the equation.
Yeah. And so let me speak to that demand side for a moment. The demand is huge. The demographics coming at the rental housing market are nothing short of phenomenal. I said that in 2010. I renewed that again in 2020. Every decade I try and make some big macro prediction like that, and it's absolutely still true. But one of the things that people fail to realize is that, during the Great Recession or the global financial crisis, whatever you want to call it, we heard a lot about shadow supply, shadow inventory, right? All of these houses that were in distress that were going to hit the market, and they ultimately did, and there was price discovery, and we've recovered from that a long time ago. But what we have now is we have lots of shadow demand of all these people living at home with their parents. I mean, it's huge numbers. I've done studies on this. I've shared it on the show before. These are giant numbers of people living at home with their parents until much later in life. I'm single, and I cannot believe how it's changed from when I was in my 20s, seeing, these different women I date that are like in their 30s. They're living at home with their parents. I mean, that would have never been the way it was when I was in my 20s, right? They all moved out after college, could afford a place of their own, bought a condo or rented one, or, an apartment. They didn't live at home with their parents. So these people eventually move out and they do some adulting. I love that expression, adulting. Right. And they get their own home and they form their own household. And that represents a huge amount of shadow demand for an undersupplied market. And that's just one area of shadow demand, the living at home population cohort.
Right. And then when those people make the decision, right, to leave home, let's just use that, your example.
Or their parents make the decision.
Right. So back in the day when I was a young man and, I left home, you bought a house. I mean, that was just the American dream. You buy a house. Well, they can't do that now for a couple of reasons. Down payment. 20% down payment, typically, unless you get some sort of federal assistance. Got to have a credit score.
Well, not if you have an FHA loan. I mean,
all right, so 5%. Yeah. All right, but the average starter home now is $400,000, so there's still an out of pocket. Yep. You got to have a credit score, right? And so what is driving the demand side of our business is, when you look, we deal in starter homes, right, Jason? So we're talking a home that costs anywhere from $300,000 to $400,000.
Which is funny that we call that a starter home nowadays. But
correct.
Ahead. Yeah.
My first home was $84,000. Yeah, right. But having said that, we deal in starter homes. And what we found is our homes, same exact home. So if you take one of our homes and put it next to a retail, as we call it, a starter home that somebody wants to buy, we're, depending on the location, somewhere between 40 and 60% less per month rent one of our homes than to buy the same exact home.
Do you have some analysis on that? Before we do that, I want to talk about why you're less expensive, okay? Yep. But I want to look at this other part of the chart you have on the screen here that shows, let's look at migration, okay? So talk about the migration.
Well, this just shows, because we're focused in the
domestic and international migration.
Right. The Southeast is primarily, the South is where the migration is from, right? Yeah. So within the country, everybody's moving south.
Right. You meant where the migration is going.
Is going, sorry, yes. And it's coming from, in particular, the Northeast and the high tax states also, and the West, California. Californians are moving to Nevada. They're moving to Texas, right?
So the migration trends are people leaving expensive markets, people leaving business unfriendly markets, and people leaving cold places.
Correct.
Got it.
And they're coming to places that offer a different climate, a different employment prospect, and a different tax structure.
Okay, so now the other one I wanted to talk to you about is the U.S. single-family permits by year. This is staggering. If you're listening on audio only, I've shown you charts like this. I've shared charts like this over the years. This is just shocking because after the Great Recession, well, during the Great Recession, I should say, the building just stopped. It screeched to a halt. And for many, many years, there was this incredible underbuilding. And that's why we got so far behind and why we have such a big housing shortage in this country. And, these housing shortage things, although I do not have as much knowledge about it, are also true in many places around the world. This is not just a U.S. phenomenon, by the way. This is a trailing 35-year average, meaning that the 35-year-old person, right? That's why you're doing the trailing, right? Do you want to elaborate on that?
Well, no, it's
because that's the year that they're forming a household or buying a house.
So typically, right, and it's getting later, right? Yep. Probably when I was young, it was probably 27, 28. Sure. When you either got out of college and you got your first job, and then you met your spouse, and then you chose to have children. You're now 27, 28. That age is pushing up to 35, which is why our average resident is now 39 years old.
And we'll be back with a lot more on this topic with this guest on our next episode. Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.